Hello, everybody. How you doing? This is a big day for two reasons. Reason number one, I have a new shirt. It's orange, favorite color. Hope you like it. Reason number two, I'm using the new laptop, the new MacBook Pro, without my Logitech webcam, and I'm hoping it doesn't skip and it sounds okay. If anybody can't hear me or has a problem with my audio right now, let me know. I'm not really sure what I can do about it, but it'd be good to know if there's a problem. And those are just really the only two reasons why it's an exciting day. I also now have my other old laptop to the left of me, so I can look at the stocks and use the internet without touching this laptop and shaking the screen every time I do it. So as I get on, I see Groupon now going down, which is kind of hilarious. Just went down 50 cents literally in the last minute. I don't know why, unless sell side put out a note or something. But this was a very interesting quarter for Groupon. I don't even know where to begin, really. First off, they dropped the 10Q yesterday when they were supposed to announce earnings this morning. And I can only rationalize that they did that because Melissa Thomas's last day was yesterday and they needed the CFO to sign off on the 10Q. And if she signed it today, she's not CFO today. There's another CFO today. And that guy didn't, I guess, prepare the filing. Of course, the company then should have released their press release the same day to give us full color about what was going on and the deck, and they didn't do that. And it's really just incompetent. So I didn't like that. I very much didn't like Q3 was going to be weak and probably estimates were too high. I also thought Q4 estimates were too high. This is a very funny company where the sell side all has holds and sells on it and hates it. It just dramatically hates it. Yet their estimates, as I've said before in my last YouTube, for every quarter and for next year are wildly high relative to reality, setting up the company to fail. I have good news on that front, though. So they put out their numbers this morning, and they the other thing that I saw in the queue, which wasn't even mentioned in the call or in the press release, was that I always knew Groupon had this other asset. I don't know what it is, but this other asset that was worth like $60 million in Q1 2020, and they sold half of it during COVID to raise cash, and they kept the other half of it. That got revalued from 30 million to 120 million. So it created $3 a share in value on a completely non-core asset that could be monetized anytime they want to, I assume, or else they wouldn't have changed the valuation as dramatically as they did, unless there was a real clearing price in that company. Probably was a private round that was done for them to actually change the valuation up fourfold from what it was prior to this quarter. And then finally, I have so much to talk about here. You have the Pfizer news today, which is a complete game changer when it comes to COVID. I think most people are moving on with their lives with COVID anyway. But if you have an antiviral, which is just a pill that can lower hospitalizations and death by nearly 90%, which is similar to what a vaccine does, you really don't have to worry anymore about hospitals ever being overrun. And you could see just the whole world open up dramatically as a result of this antiviral. I can't understate how significant a 90% reduction is. The Merck was 50%. And if I told you it was a coin flip of whether or not you were going to be hospitalized from COVID or not if you took it, I don't think that would be great to you. That's not, of course, what happens. You don't have a 50% chance of going to the hospital if you get COVID. But I'm just saying, if I told you the risk was reduced by 50% after you got COVID, you'd be happy about that. But I don't think you would bank on it. But a 90% reduction is just phenomenal. And I think that if you take the $3 a share gain, which is real money, that's a real value that came out of nowhere, and you take the Pfizer news, I think it would be up the full $3. Again, doesn't always work like this, the stock market, of course, but it should be worth $3 more today as a result of a balance sheet addition of $3 that's fully monetizable. And then I also think you would get probably a 10% pop on the Pfizer news if there was no Groupon earnings today, which together would bring you up 22% or so. Right now, we're up 6%. So in my mind, the market is saying that the earnings were good for a negative 15% move in Groupon. Now, they missed earnings, like I said, because you can't use that unredeemed vouchers. It doesn't mean anything, right? This was basically customers that bought the vouchers in a prior period, a year ago, 2 years ago, and they didn't use them, which of course is not good for business anyway. And all that revenue and gross profit and EBITDA is not replicable and is zero quality. So you can't include it. So if you take that out, and then you also look at quarter four guidance, the good news is on the call, they said that quarter four guidance has very little of unredeemable vouchers in it. That was one of my concerns, that the guidance of, I think, like 30 million at EBITDA for quarter four was going to be loaded with this unredeemable vouchers that is low quality. They said it's not material to quarter four. If we unpack the quarter four guidance, which is again the 30 million at EBITDA, and we use it in context of knowing that the goods business has decelerated dramatically from last year and will be a big headwind in Q4, the underlying locals business and locals EBITDA should be pretty healthy compared to quarter four of last year and quarter three of this year. Is it going to get the same kind of seasonal bump that it's gotten in the past? Maybe not. But I think the company has finally set itself up for realistic expectations in quarter four and hopefully for 2022. And that hasn't happened in a long time. So when you're sitting here at $24.40, you have to ask yourself, how much EBITDA can they do in 2022? That's real EBITDA, not this voucher crap. And how long does it take for the company to show that this is not a dying business, but it's a sustainably growing business, which they've never shown in like 10 years? And when will we know that? So we could know that at quarter four. If they put up a quarter four number, let's say they put up an EBITDA number of 45 or 50 million. Remember, this company sandbags like you cannot believe. So you can't trust their guidance. They could easily outperform that 30 million by $20 million. If they put up a 45 or 50 million EBITDA number in quarter four, that was high quality, so it's not unredeemable vouchers, and it's predominantly local, since goods is such a small part of their business now, I mean, the stock would double. Because you basically are saying that you're moving in the right direction on a quarter-over-quarter basis and on a year-over-year basis, and you're seeing the effects of all the COVID restrictions abate. If quarter four is in line, and then they guide to a reasonable 2022, I just don't really see how you have any downside here. Just to remind you, that asset is worth $4 a share. So adjusted for that asset that they could sell whenever they wanted to, this is a $20 stock and a $600 million market cap. It's hard to figure out the exact enterprise value because there's a ton of liabilities on the balance sheet from accounts payable and stuff like that. To make it easy, I just say net cash is equal to net debt, though there's probably some net liabilities. So that's probably not the most conservative way to do it. I think other people count net cash and don't count any of the liability, the short-term liabilities. So, but for simplistic sake, I'm going to say it's a $600 million EV, a $600 million market cap, and adjusted for the $4 monetizable asset. And I think that they can, do next year pretty easily 40 million a quarter in EBITDA, quarters 1 through quarter 3, and then 50 million in quarter 4. So that would be 170 million of EBITDA that would be up from something like 100 million of EBITDA this year if you take out the one-time unredeemable vouchers. Obviously, that would be a huge move from 100 to 170 million, and that's nowhere near the levels it was at in 2019. I think that would only require them getting back to like 70% of the business of 2019 in 2022. I think if they did that, the stock would triple. You'd have a $70 stock, 2.1, 2.2 billion kind of market cap on 170 million of EBITDA that was growing from, the previous year of 110 million. It wouldn't be expensive by any means. Your downside is that they keep bleeding customers every quarter, a million here, a million there. Then all of a sudden, you're just left with this truly melting ice cube that they cannot stop from melting. And that's a real risk. There's no doubt about it. I just think that your downside here is so different than it was when it was 37 or 45 or 60 or whatever. So how have I positioned myself? I'll talk a little more about, I'm not done talking about the company, but I sold some stock today because it was huge. It was as big as a 50% delta adjusted position. And now it's down to a 37% delta adjusted position. Most of my position is all in options. So I'm huge in those January 23, 35, and 40 calls. I have an April 30, 35 call spread on. I have a ton of January 25 calls. And I have December 30 calls that are probably going to be worthless. I have some November 25 calls. And I'm not sure the best way to play this name now is through options, only because I think, famous last words, but I think the downside risk is much lower than I thought going into today. It's not that I thought the quarter was good. It wasn't, but I expected that. And I think they set themselves up for a quarter four that's very attainable. So I don't really know how you lose capital from here. And if you can't lose capital, again, none of this is investment advice, obviously. If you can't lose capital, then why waste the money on options premium? I would rather probably just own stock. And based on most of my options are all spreads, and I'm short some January 20 puts, and my position's crazy. So, you shouldn't look at it as me being heavily levered through options, but I am, because I have huge upside in those January 35, January 40, Jan 23s calls if this thing really works. The two comments they made on the call that were very bullish, or one much more bullish than the other, that I don't think should be underestimated at all, is they said that inventory is coming back on in quarter four, and they have good visibility into that. And I have to go look at the transcript, but they said something like 10 to 12%. They would have a 10 to 12% bump in quarter three if the inventory that's coming on in quarter four was on in quarter three. And that's a real data point, and that's pretty amazing if that's true. And then two, they said that October was better than September and August. Well, I hope it was. It obviously wasn't that great because they didn't give us the number, right? The company really, the way that they disclose things is very sketchy. Obviously, they decide they don't want to tell us every month anymore. But they did tell us that October was better than the previous 2 months. And they told us that the inventories come back. So, and then finally, the most important thing, that's not true. I should say it's the most important thing, but it's important, is guess what we still have, people? We still have an interim CEO. And I can assure you, after the CFO quit, the chief accounting officer quit, and the feedback they've heard from large holders, if they haven't named Aaron CEO now, after 19 months or 18 months as interim CEO, there's a reason for it. And it's not because they're lazy, and it's probably not because they're dumb. So my guess is they are definitely working on something, or I shouldn't say they definitely working on something. They are likely working on something. And the closer we get to stability in a normal environment, the easier it'll be for them to complete a transaction. And I think they could be there now. I think a private equity firm or a strategic could probably get some pretty good visibility into what the business looks like now. It'd be easier, obviously, after 3 or 4 quarters from now. But if they named Aaron permanent CEO today, I would obviously be much less enthusiastic about there being a strategic transaction. But they didn't. So now that's what leaves us. I mean, on your downside, it's not so much that you try to figure out what the EBITDA could be. Remember, the EBITDA is kind of bullshit. You have a lot of stock-based comp and you have CapEx. So if the company does 100 to 120 million in EBITDA, it's basically breaking even on a free cash flow basis after CapEx and after stock-based comp. And of course, if they keep bleeding customers every year, you won't even be left with a company with 100 to 120 million of EBITDA, right? It'll keep declining. So it's very hard for me to tell you what your margin of safety is unless unless they really can just hit the bid or whatever that bid is if things go south. And I don't know what that bid would be. I don't know if it would be strategic, who that strategic would be, or if it would be private equity. It's still true that Yelp could pay $1 billion for this tomorrow, which would be like $5 a share or something. And even more if you take that $4 from that strategic position they have. If they paid $1 billion for this, they would probably add something like 250 million in EBITDA in the first 4 quarters with synergies and with assuming Groupon does, like 150 million. So 100 million of synergies, very modest, and 150 million of EBITDA. So they could buy Groupon at 4 times EBITDA at $1 billion purchase price. And Yelp's trading at probably 12 times EBITDA, something like that. Paying 4 times EBITDA when you're trading at 12 times EBITDA. And those are very conservative numbers, a 250 million kind of EBITDA number. That creates a lot of value. If you assume that you could even just get that Groupon EBITDA up to 8 times, you just created $1 billion in value for your shareholders by doing that. And obviously Groupon being part of a larger company, more diversified, would be better for Groupon. Because then all of this variability with the turnaround isn't as important because it has other diversified EBITDA around it. So let's see what some of the questions are here. Are you thinking it's basically dead money to the next earnings? I mean, if you look at what Groupon's stock price has done, except for the last 3 months, the last 3 months, it did trade like dead money after it blew up. So it got down to the $23, $22, $24 range after the first week of earnings. And then it just stayed there, right? 22 to 25 for 3 months. I don't think that's the case here. I don't know what it will do. I think the downside is extremely limited. I just can't see this going back to the 21 to 22 area. So, I mean, if it goes to 22, you're risking 10% here from 24, 25. And then your upside, I think, is to the mid 30s in a takeout. I don't think it goes to 30 outside of a good quarter or a takeout. Could it go? I think it should be in the upper 20s right now. It should be $27, $28 would be a fair price for it right now, is what my gut tells me. So I don't think it's dead money. I think that, I mean, this stock is so hated. The short interest is at the highest of all time by like a few 100,000 off. So it's over 4 million shares are short. I have no idea what they're hanging on for at this point. Every sell sider has a hold or sell on it, and they're not going to upgrade it on this. So you're going to see a bunch of blah notes, still bled, Groupon lost customers. They had very low quality earnings with the unredeemable vouchers, and turnaround remains elusive. That's what your notes will say. So that's why short-term calls doesn't make a lot of sense to me. I don't love my January 25 call position, but I think it could be taken out in the next 12 weeks. I don't understand why the interim CFO only got a 9-month package when the previous CFO, interim, not permanent, interim, got a 4-year package. And Aaron got a 2-year package when he became interim CEO. A 9-month package is ridiculous. You only do that if you are worried about a change of control and you don't want to give this new interim CFO a multi-million-dollar payout when it's going to be a short-term transaction. Why is quarter four usually good for them? Did I understand this correctly? Yeah, quarter four is their seasonally high quarter, Max, because of gifts. People gift Groupons and people gift goods. So I'm pretty sure the goods business was probably seasonally why it was the best quarter for them, because people bought crap for Christmas and Hanukkah and Kwanzaa. Now, goods is a much smaller part of the business, so it should be less seasonal, but you still could gift people Groupons. I mean, gift someone a massage or whatever. Are you implying there? Sorry. Do you think IBKR changes margin requirements back to normal? No. What IB has been doing with margin on Magnachip and Groupon is super weird. They've been just bumping it from like 35% to 47% and just going up and down. With Magnachip, they've been doing it for 6 months. Every 2 weeks, it goes up or down from 35 or 33 to 47. And it tops off at 50%, I think. So I think Groupon would probably have to get back into the 30s for them to stop fucking around with the margin. I have no idea what they're doing. I actually think Interactive Brokers likes to, have their customers go bald, and they like having them lose money. They have no respect for their customer base. Their only interest should be that they don't lose any capital from a margin problem. But the way they handle margin is above and beyond what they need to do to make sure they don't lose money from a margin perspective. It's atrocious. I hate the company. Are you implying they're going to be bought? Groupon's been for sale for like 4 years, and they haven't been bought, till now. Now, I can't emphasize enough that at $24.35, this is a $1.20 stock pre-split. $1.20. Groupon was $3 or higher forever before February of 2020. I'll repeat, before February 2020, Groupon was like, maybe it was $2.50 to $4 for years. And they were trying to sell themselves, but the stock was $2.50 to $4, which today in the post-split world is 50 to 80. 50 to 80. If you're 50 to 80 and you're trying to sell yourself, it's very 24. Now, the business is different today than it was back then. But you kind of have a different story now. I like the Groupon story better today than I did 3 years ago. 3 years ago, it was a big bloated machine that was just trugging along, dripping out customers, dripping out gross profit. And it was kind of like trying to turn around the Titanic. But today, because of COVID and because they fired so many people, it's a much leaner company, and you should see progress quicker, and there should be a ton of operating leverage once they hit an inflection point. And I think a private equity firm could see that too, much more so than they could have 3 years ago. The board here is just so bad. The interim thing is unprecedented. The capital allocation is the worst. If it's cheap, do a buyback. Look where they last bought. Communication is awful. Yeah, I couldn't agree more, Glenn. Even just from a signaling perspective, you would do a buyback. But there hasn't been an insider sale or insider buy since June of 2020. Not even a 100-share sale by the interim CEO, who's got a lot of stock now, or by anybody that's on the board, or a buy. Could be reason to believe that the same reason why there's no buyback is that there's no insider trades, is that they have material non-public information, and they're working on stuff. Again, I have nothing to base this on except all the signs point to that. When I spoke to them last, I told them they should have a capital allocation strategy. They should tell Wall Street, once we get to X net debt, this is what we plan on doing with our capital. and have a vision for it. They've done none of that. And to their defense, they're in the middle of, trying to turn around this business that's not doing well. Because make no mistake about it, the business is not doing well. So, I think they're trying to focus on one thing at a time, but you can, walk and chew gum. So I would expect them to articulate a plan for their cash flow. They also had very negative working capital last year as the goods business transitioned to 3P. That should reverse next year. They should start generating free cash flow again. And they should have a plan for that free cash flow. Quarter four, do you think supply chain issues will actually help them because they are mostly in services? If people can't buy physical goods, they might buy more Groupons. Yes and no, Max. The good stuff is definitely not going to be a big deal for them. So we're lucky about that. But the problem with the services is they blame the fact that most of these businesses have a labor issue. So they don't have excess capacity, whether it's a restaurant or a local, a boat tour or whatever. They can't get, the fifth boat driver to drive the extra shift. So they're sold out on boat tours. So those things are still going to take time to work itself through too. But, I don't have any insight into that. I just know that if you take the company at their word on inventory, and they are saying that they have very good visibility into inventory coming back, that is a very good sign for the business. If they're lying, then, we're probably fucked. But, Aaron has said twice that they have conversations with their largest customers and they know what the visibility is to that inventory coming back. So I don't know a lot of stocks that, this is trading at 5 times this year's EBITDA, which is insane, right? And if they do the numbers I think they will next year, it's trading at like 3 times next year's EBITDA. Clearly, that's not going to stick. If the numbers get put up, the stock's going much higher. And if the numbers don't get put up, maybe you go down to 15, and they have to, they're going to have to do something. They'll have to hit a bid. I don't know what that means. I'm being honest with you. I don't know what that means. If there's no one that wants to buy the company, there's no bid to hit. And, they might also be stubborn and not want to sell for $22 a share. So there is risk of permanent capital loss here. I just think you're a long ways out from that happening. It's still a very big business. You would probably do another round of cost cuts, take another 100 million of cost out of the business, and then all of a sudden you have a nice amount of EBITDA again. And then you continue to try to, start to get the business back to growth. But that's what they would probably do next. They take another 100 million of cost out of the business. Mind you, my EBITDA number for next year is also partially predicated on the fact that the cost structure for all of 2022 will be less than 2021, as all the cost cuts that happened in 2021 fully annualized. If they get bought, you think 35 a share at the low end. What do you think the range of outcomes is? It's pretty hard for me to see how they get sold for less than $32 or $33 a share. That's not because it's partially because where it's trading now, I should say. And I hate to anchor on that, but I think that you would have a competitive process that would yield higher price than that. A private equity firm could borrow $300-400 million, maybe even $500 million against the business, I would think, with the EBITDA they have. They don't even need to do that really to have fantastic equity returns. If the turnaround works, they could do a div recap to themselves in a year or two as the stabilizer gets better. I think there's huge upside still, Max. That's why I think right now your YOLO, crush it trade would be to, if you don't want to just own 35 and 40 Jan 23 calls naked, which is probably the best way to do it, it's putting on like a 70-90 call spread for next year. I got to close the door. I hear my kids. They're driving me crazy. Hold on one second. Hey, boys. How you doing? Come on. The reason why the 70-90 call spread to me is appealing is that Jan 23 is a really long time from now. So if they do the 170 to 190 of EBITDA in 2022, I think they could do, and the business is showing acceleration, the street's going to think they're going to do 220 to 240 in 23, and you'll have a $3 billion market cap. Easy. Which is $90 a share. And I think you're only paying like, I don't even know what those call spreads are today. I'm not saying those are my favorite trade, but I have those on from a while ago. Those are 47 cents, according to IB. 47 cents for a $20 payout. Now, again, I don't think that's the best way to play it. Personally, I think you'll own the 35 or 40 Jan 23 calls. And you do that with also having stock on, so that if it does, your risk with owning those Jan 23 calls is this gets acquired for $35 next week and they all go to zero. So you have to be able to make money off of that outcome happening with the very high call strikes in Jan 23. My favorite trade is probably three things. It's owning common right now. It's I like the April 30-35 call spread. I have that on already, but that's the best way to play quarter four earnings, continued COVID recovery, and a buyout. And I think those April 30-35s are probably a buck 15, a buck 10, something like that. So that's my favorite call spread. And then I would own the Jan 23 35s and the Jan 23 40s. And I wouldn't put on a spread there. I would just own the calls. And then finally, if you want to put on a YOLO spread, it would be a Jan 23 70 90 spread. I think those April 30-35s have a very good chance of paying out, because you don't not only need to, you have the quarter four readout in February, but that's a lot of time from now for a lot of things to happen, whether it's the universe, going back to normal, or it's a strategic transaction. That's 6 months. That covers the next 6 months. It's a long time. In the third quarter alone, if these merchants who were mostly things to do merchants were back on our marketplace, we believe we would have picked up 10 to 12 percentage points in locals from 2019 levels. Thanks, Drone. That's the language. And yeah, I mean, that's a big deal. 10 to 12 points is a big deal. So it's a very bullish data point. And the most important takeaway for me is that I think, again, for the first time, we'll have a quarter that is beatable and is attainable, and we might finally have that inflection point where people see that this is a growing business, not a shrinking business. The other thing you have going for you in 2022 is the stupid goods transition is over. That ends this quarter, and it should be a very small part of this quarter. So Wall Street shouldn't have a hard time modeling the revenue number for this quarter, because it's, they basically gave it to us. And your only problem with 2022 is going to be that the revenue comps are going to be terrible, because 2021 had a ton of the first party goods in it. But you also have the other problem you're going to have is that in 2021, a lot of the EBITDA is going to be this unredeemed voucher. And the company's going to have to do a good job of explaining that 2022 is not comped directly off of 2021. It shouldn't be a big deal if the billings are up and billings show growth and the EBITDA is solid, the stock will work. It's just that simple. It's not a rocket science with this thing. So yeah, I feel pretty good about it. I didn't feel good about it last night when I saw that it was all shenanigans with the unredeemed vouchers, but I feel good about it. I feel better about it today than I have at any time in the last 3 months. And that's saying something. I'm not too worried about waking up in the morning with it and thinking it's going to be down. You know, I think it ends up working over the next few weeks because everybody was positioned wrong in this thing. Everyone would either short it, all the longs, you know, got out of it, and I like it. I like the Groupon. Again, I'm smaller than I was going into today, but let's be honest, a 37% delta adjusted position is huge. And I have huge upside if it gets taken out of 35 or 45. So there's plenty of leverage in this stock for me. And that's, you know, that's a good way to be. All right, that's enough with the Groupon. Let's talk a very little bit about Magnachip. I keep adding to Magnachip. It's a bigger position for me now. That's over a 50% delta adjusted position. It's all common. So I have 50% of my portfolio in Magnachip common. It's completely for sale. You can buy as much as you want, $19. So there's no rush with this thing. Somebody wants out and wants out every day. What has happened in Magnachip recently? There were 2 articles that came out this week. One was by CTFN and one was by Deal Reporter. The Deal Reporter was not based on any sources. The Deal Reporter article just had 2 attorneys that are intimately familiar with the CFI US process and what they think is going to happen based on what they are reading in the public domain. They have no insight into Magnachip or into the process that's happening with Magnachip. They both think it's very unlikely that Wise Road deal is approved based on what we know today. Okay, well, no shit, Sherlock. You know, and I was about to make a crude joke. I'm not going to make it. I have some sort of weird view that one day, this won't happen, but one day my kids watch one of these videos, they probably will have no interest in anything their dad did, I'm sure. And then I make some, I make some terrible joke, and my children cringe at whatever filthy joke I was just going to make. Anyway, it's here forever, posterity. And the other article was CTFN. Now that one was much more interesting. Now CTFN has done articles on Magnachip in the past, and nobody believes anything that they have to say. So with that being said, they had 2 sources. The first source said that they are optimistic that CFI US is going to approve the Wise Road deal based on the changes they made to the amendment to the filing. But they admit that they have no insight into the process. They say the process is kind of a black box and they don't have any insight into it. So that's the first source. The first source also says that they are in a rush to complete it because they believe that there are other bidders that are interested in Magnachip still. Then there was a second source that said, and the second source is from somebody that was involved in the bidding process for Magnachip, but left the process early on. And they said Cornucopia is still the most likely one to acquire the company if Wise Road doesn't. And there are other companies still that are interested in them as well. But they had no insight, and CTF had no insight if any of these companies were not Chinese. I mean, what to unpack from all that? Not a lot, except since I have it at 0%, basically, you know, less than 5% that Wise Road acquires Magnachip, I'll take any chance we can get there. That would be a great thing to wake up to in the middle of December, that Korea and the United States have approved the transaction. I talked about Magnachip last time, so I'm not going to go into say the same things. So you should go look at my last video if you want to hear more, but I'm not going to get into the earnings and all that stuff. But I think 2022 for Magnachip is an incredible setup. So in 2022, you're going to have, there's two divisions in Magnachip. There's power and there's display. And I have no idea what either of them do. But the display business has been the one that's been hurt from supply issues. And there's like OLED and cell phones and screens and shit. And they had a great quarter from a margin perspective because there was such a tight supply. That will loosen itself up in 2022 somewhat, the company has said, as they are securing more capacity. So that is a huge catalyst in and of itself. The second thing is the display business, the power business, they've been putting up a CapEx in that for the last 18 months, and they'll have 40% more capacity starting in 2022 on the power side. And the power business is booming. It has been for the last 3 quarters. So from both ends of the business, display and power, you should have a very good, strong year in earnings. You then have some form of end to Wise Road. That's either going to happen in March at the latest. That's when a deal has to end. Or in December. Those are the 2 times it could end. If it goes to March, it's my belief strongly, you'll either have a new deal that happens shortly after. And that new deal, by the way, it doesn't have to be for $29 a share. There's 2 positives that people are overlooking. First, they're going to get a break fee of between $1.50 and $2. So if somebody else could pay $27.50 for Magnachip, and you add the $1.50 of break that goes to the balance sheet, and we get the same $29. Of course, they would pay $29, but the balance sheet's different because of the breakup fee. Okay. 2, if they sign a deal in March 2021, it's a full 12 months after they signed the deal in March 2020. And companies are worth more as time goes on. So they haven't generated a lot of free cash flow this year because the money has gone to CapEx. But make no mistake about it, it's a year further along in whatever your DCF is of Magnachip. So I believe you probably have added $1.25 in value, which is basically the earnings, as well in the 12 months from March 2020 to March 2021. So now you're up to $30.25 of value. Oh, excuse me. If you want to pay the exact 29 the other people paid, you had $1.50 in the break and you had $1.25 in the accrued earnings, and you get up to, $31.50 or $31.25 or whatever. And that would just match the Wise Road price. Okay. I have no idea what happens and what someone pays if anybody buys it. But if none of that happens, you'll have a dividend recap. Some element of return of capital. They'll have 8 or so in cash, no debt, whether they pay out 2, 3, 4, 5, whether they pay out 10 and take out some debt, I have no idea. But you'll have some element of a return of capital. Let's say they only return $4. If they return $4, you have a $15 stock right now with $4 a share in cash on it. And they should do as much as $1.50 in earnings next year. Growing double digits. It's crazy. The stock will double over the course of the year as people get less concerned about the Samsung risk. That's the whole game here. Does Samsung pull any business if China doesn't buy them? And what does the business look like after China doesn't buy them? Do they piss off Korea so much that the Samsung business is permanently impaired? That's a black swan event, and that's the reason why the thing's trading at $19. And I'm totally comfortable with that risk. My buddy did an analysis of what would happen if Samsung pulled, I think it was like half of their low-end business, because that's what the article says they were going to do, pull some of their low-end business and give it to Taiwan. And I think it shaved 10 to 15% off of earnings. That's it. And there's no reason to believe, A, that they're definitely going to do that if China doesn't buy them, and B, that there won't be enough demand for them to make up from other business if that does happen. So I think that the news flow over the next 6 months is pretty amazing. We already had the earnings, so the earnings aren't going to happen. Your headline risk is something that's announced with Samsung that they're pulling a ridiculous amount of business from them. It's definitely possible. So I'm not going to say it's not possible. It's definitely possible. You have a black swan there. Your headline risk is that CFIUS blocks. If that happens, good, because you could finally move on from Wise Road, and we could either get our dividend or we can have a new buyer. Some might ask, how come we don't have a new buyer now? Why do you have to wait till Wise Road dies? There's a lot of reasons for this. The company cannot approach companies or any strategic buyers or financial buyers. They have a contract with Wise Road. They have to be approached, and they can't market themselves. And also, the company wants their breakup fee. If you're Magnachip, your business is still moving along. Why not keep this going to get your $1.50 to $2, which is a lot of money, and then remarket yourself to new buyers after? That's what I would do if it was my own company. I wouldn't be in a rush to sell it for $28. You can't even sell it for less. If you're at a $29, what are they going to do? They're going to say that a $28 bid is superior. It's not. So the only thing they could take is a higher bid, and Cornucopia is the only one that's offered that, and it's all China. So it can't be a superior bid because they probably can't get approvals, just like a Wise Road can. All that being said, the stock does not go up. So this is the kind of thing where you have to assume somebody has more information than you. I think it's more likely that it's just a complete black box, that there's no natural buyer for this stock. It's not in any indexes. Mutual funds won't touch this, and the ARB community is completely out of it, is my guess. It's trading at $19 with a $29 bid, and it's a South Korean company listed on the New York Stock Exchange. So that's where I'm at with Magnachip. I think that we're going to get good news there. Thoughts on ATSG these days? I don't even know what ATSG is. Did you mean ATX? No, I don't even know. What is ATSG? Air Transport Services Group. Absolutely no idea what ATSG is. So sorry about that. Any other questions? AXSM. I knew you meant something different. I sold a little of my AXSM call spreads. They're about 175 basis points now. Talk about black boxes. I still think that's approved, but I do not have any kind of high confidence in the outcome there. The longer it goes, the better it is. Like I said, it's very easy to give someone a CRL, and there's been no CRL. They're reporting earnings, Len, I think on Monday, and that could move the stock huge. Because if they give any extra added color about what's going on, it'll move. Now, I have to think if they were in possession of expecting a CRL, they would notify the market of that, I would think. Could be wrong. So I don't expect them to come out on Monday saying we expect a complete response letter, but it could happen. I don't love it as much only because I don't know what the upside is in it. So my call spreads are 50-60s and a little 50-70s. And you're not getting that 5-1, 6-1, 7-1. I was getting 9-1 returns. Now you're getting 3-1 or 4-1. And that's obviously not the same setup that I was getting, which is why I cut it. But it's still 175 basis points. So I like it enough. I'll tell you another thing that's super weird. IMVT, Immunovant, I still own that. It's a small common position, but I own a lot of call spreads going out to Jan 23. I don't recommend you putting those on. I don't recommend anything, but I wouldn't put them on today if it was me, where they're at. But they report earnings today without any notification. Their earnings press release only had their financials in it. Didn't have a single line about from the company telling you what the status is of the drugs starting up again, and not a single line about the drugs starting up again. Scared the crap out of me. And no conference call. They've done a conference call every time since they've been a public company. Now, if you go to their 10Q, they do reiterate their whole timeline for the restart of the trials. So I don't think there's any risk there. They wouldn't put that in a 10Q if they were in possession of bad news from the FDA. But it's extremely weird behavior. And I think that part of that might be because Roivant is going to roll it up in the next 6 months. I still think that's going to happen. I don't really understand why else they would be so tight-lipped in the press release and not do a conference call. They did do the Roivant Analyst Day 5 weeks ago, but I would still think they'd have a line in the press release saying we're engaged with the FDA and we look forward to updating you in the future, some bullshit. And they didn't do that. The stock was above 9 this morning, but now I see it selling off a little bit. All right. How was the new laptop? I guess I'll see it on my own. I'll play it back a little bit and see how it worked, but no one complained, so hopefully it was better. Have a great weekend, everybody. Let's see these stocks go up, please. And take care. Bye. Thanks for watching.